Power rarely announces itself. It does not arrive suddenly, and it does not depend on headlines. Real power moves slowly, accumulates quietly, and reveals itself only after time has already done its work. While markets obsess over quarterly earnings, elections, and daily volatility, the forces that truly shape economic dominance operate on a completely different timeline. History makes one fact clear. Money follows power, and power follows control over time. Nations rise not because they move faster, but because they position earlier and wait longer. The greatest economic shifts of history were never reactions. They were preparations. In the modern world, power is often confused with financial size. Market capitalization, currency volume, and asset prices are treated as indicators of dominance. But these are surface measurements. Beneath them lies the real foundation: control over production, resources, and the physical inputs that make growth possible. When control over those inputs shifts, money eventually follows, regardless of narratives or policy. China's rise must be understood through this lens. For decades, it was framed as a manufacturing story: cheap labor, export growth, and factory output. That interpretation misses the deeper strategy. Manufacturing was never the end goal. It was the learning phase. The real objective was upstream control. Time is the critical variable. While Western economies optimized for speed, efficiency, and short-term return, China optimized for duration. Projects were planned across decades. Supply chains were secured years in advance. Capital was deployed not to maximize quarterly profit, but to minimize future vulnerability. Modern civilization depends on a narrow band of physical inputs. Semiconductors, energy systems, transportation networks, medical technology, and defense infrastructure all rely on specific materials that cannot be substituted easily. Copper, lithium, cobalt, nickel, rare earth elements, silver, and a range of specialized metals form the skeleton of technological progress. Without them, innovation stalls. China understood early that whoever controls these inputs controls the pace of development. Financial capital can move instantly. Physical capital cannot. Mines take years to develop. Processing facilities take decades to perfect. Expertise compounds slowly. Once established, these advantages are extremely difficult to dislodge. This is where time becomes power. Rather than competing endlessly in finished goods markets where margins compress and competition intensifies, China moved upstream. State-backed enterprises began acquiring mining rights, processing capacity, and long-term supply contracts across multiple continents. Africa, South America, Central Asia, and Southeast Asia became extensions of a long-term resource strategy. These moves were rarely dramatic. They did not trigger immediate market reactions. That was the point. The absence of urgency allowed accumulation without resistance. By the time dependencies became visible, positions were already entrenched. Processing, not extraction, became the true choke point. Raw materials can be found in many places. Processing them at scale, with consistency and expertise, cannot. Environmental regulation, capital intensity, and technical knowledge create barriers that markets alone cannot overcome quickly. China invested heavily in this layer while others outsourced it. Rare earth elements illustrate the timeline advantage perfectly. Even when mined outside China, they often require Chinese processing. That dependency did not appear overnight. It was built gradually, year by year, investment by investment. At the same time, China accumulated vast foreign currency reserves through trade surpluses. Holding paper claims is useful only as long as confidence holds. Over time, the strategic logic changes. Converting financial claims into physical assets reduces exposure to inflation, sanctions, and geopolitical leverage. It transforms abstract wealth into tangible control. This conversion does not happen in a single transaction. It happens over years. Through steady reallocation, every ton of metal acquired is a unit of future optionality. Every processing facility built is a reduction in dependency. Every supply contract secured is time purchased. Western economies largely abandoned this long horizon thinking. Resource security was treated as a solved problem. Just-in-time supply chains replaced strategic stockpiles. Efficiency replaced resilience. As long as markets delivered, planning seemed unnecessary. That assumption only holds in a world without strategic actors. What we are witnessing now is not a sudden disruption, but the delayed recognition of a shift that began years ago. Power has already moved upstream. Money has not yet fully followed, but history suggests it will. Time favors those who prepare early and wait patiently. It punishes those who react late and move quickly. This is not a story about confrontation. It is a story about duration, about who planned for constraints before they appeared, about who understood that the future is not decided by speed, but by positioning. Power, money, and time are inseparable. Ignore one, and the others eventually move against you. Scarcity is often treated as a market imbalance, a temporary mismatch between supply and demand that prices eventually resolve. History shows a different reality. Scarcity, when managed deliberately over time, becomes a strategic instrument. It reshapes behavior, reallocates capital, and redefines power relationships without requiring confrontation. In long cycles, scarcity does not emerge by accident. It is cultivated. Modern economies are built on the assumption of continuous access. Access to energy, access to materials, access to components, access to logistics. This assumption worked in an era of surplus, globalization, and low geopolitical friction. It fails in an era where resources are finite, supply chains are stretched, and strategic actors plan decades ahead. China's approach to resources reflects a deep understanding of this shift. Rather than treating commodities as interchangeable inputs, subject only to price, they are treated as strategic constraints. Constraints that can be softened internally while being allowed to tighten externally. Over time, this creates leverage. The most important insight is that not all scarcity is visible. The most powerful forms develop slowly below the threshold of market panic. They are embedded in supply chains, processing capacity, logistics infrastructure, and expertise. When scarcity finally becomes visible in prices, the strategic work has already been done. Consider the structure of modern technology. A smartphone contains dozens of specialized materials sourced from multiple regions. An electric vehicle depends on a precise combination of lithium, cobalt, nickel, copper, and rare earth elements. A wind turbine requires permanent magnets that cannot function without specific rare earths. A semiconductor fab depends on materials measured in parts per million, yet essential to yield and reliability. These systems are not resilient by default. They are efficient, not redundant. Redundancy costs time and capital. For years, efficiency was rewarded. Resilience was not. China exploited this asymmetry patiently. Instead of competing at the end of the value chain, where substitution is possible, it moved to the beginning. Mining rights were acquired, but more importantly, processing and refining capacity was centralized. Logistics networks were built. Technical expertise was accumulated. Environmental costs were absorbed domestically to secure long-term advantage. Processing is where scarcity becomes structural. A mine can be developed in multiple jurisdictions. A processing ecosystem cannot. It requires skilled labor, regulatory tolerance, infrastructure, and years of iteration. Once established, it creates a time barrier that markets cannot bypass quickly. This is where time itself becomes leverage. While Western economies responded to scarcity signals reactively, China responded preemptively. Strategic stockpiles were expanded not because shortages had occurred, but because they eventually would. Capital was deployed not to exploit price cycles, but to secure continuity. Scarcity also alters incentives across markets. When access to materials becomes uncertain, firms change behavior. They accept higher prices. They sign longer contracts. They relocate production. They compromise on margins to secure supply. Each adjustment transfers value upstream to the holder of resources. Over time, this reshapes entire industries. Innovation becomes constrained by access rather than imagination. Product design adapts to availability. Research priorities shift toward what can be sourced reliably. Scarcity becomes an invisible architect. This process does not require export bans or overt restrictions to be effective. The mere concentration of supply is enough. Optionality belongs to the supplier, not the buyer. Timing favors the holder, not the seeker. Silver offers a clear illustration. Demand has expanded across electronics, energy infrastructure, defense, and medical applications. Supply growth has lagged. What appears as a price spike is in fact a timing mismatch. Years of underinvestment meet sudden convergence of demand. Once the imbalance is recognized, the response is not immediate supply expansion, but competition for existing stock. The same pattern applies across copper, lithium, and rare earths. Projects announced today may not produce meaningful output for a decade. During that decade, scarcity persists. Time amplifies advantage. Western responses often underestimate this dimension. Policies focus on incentives, subsidies, and reshoring initiatives. These are necessary but slow. They collide with regulatory constraints, labor shortages, and capital discipline. Time cannot be compressed indefinitely. China's advantage lies not only in what it controls, but in how early it moved. Early action buys time. Time compounds advantage. History shows that resource-driven power shifts unfold gradually, then suddenly. For years, dependencies are dismissed as manageable. When stress arrives, alternatives are proposed, but alternatives take time. During that time, leverage is exercised. This is not a moral judgment. It is a structural observation. Scarcity rewards those who anticipate it. It punishes those who assume continuity. As the global system transitions from abundance to constraint, the value of time increases. The future belongs not to those who react fastest, but to those who positioned earliest. Scarcity is not a crisis. It is a condition. And time determines who benefits from it. Money is often mistaken for power. In reality, money is a claim on future production. As long as those claims can be honored, currency retains authority. When the underlying capacity to produce erodes or shifts elsewhere, money does not disappear overnight, but its influence decays over time. This decay is rarely dramatic at first. It unfolds gradually, then accelerates when pressure converges. The modern global monetary system was built on the assumption of permanence, permanent access to resources, permanent confidence in institutions, permanent demand for sovereign debt. Time has begun to challenge all three. For decades, the US dollar benefited from unique structural advantages. Global trade was denominated in dollars. Energy markets reinforced dollar demand. Foreign reserves accumulated in US assets. This created a feedback loop where dollar dominance sustained itself. But feedback loops work in both directions. When incentives change, flows reverse. One of the most underestimated forces in monetary systems is duration. Debt is not static. It matures. It must be rolled, refinanced, or serviced. As debt accumulates faster than productive capacity, the cost of time increases. Interest compounds. Confidence becomes conditional. The United States now carries debt levels that require continuous external participation to remain stable. This stability depends on foreign holders choosing to maintain exposure. That choice is not ideological. It is economic. As global actors diversify reserves and convert paper claims into physical assets, marginal demand for U.S. debt weakens. Even small changes in allocation create large effects at scale. Yield sensitivity increases. Volatility rises. Japan provides a clear illustration of how time pressures monetary relationships. For years, Japan's low interest rates enabled massive capital flows into U.S. assets. The yen-carry trade became one of the largest structural supports for dollar-denominated markets. This support was not guaranteed. It was conditional on time and rate differentials. As domestic inflation rose and the yen weakened, Japanese policymakers faced a choice: protect global capital flows or protect domestic stability. Time eliminated ambiguity. Currency stability became the priority. This shift forces capital repatriation, asset sales, and a gradual unwind of positions accumulated over decades. This is how monetary power erodes, not through confrontation, but through necessity. China's approach to currency reflects a different understanding of time. Rather than defending a currency through open markets alone, it reduces exposure to external systems, settling trade in alternative currencies, building parallel financial infrastructure, accumulating assets that hold value independent of monetary policy. Every dollar converted into a physical resource is a reduction in future vulnerability. Every long-term supply contract signed outside the dollar system is a marginal decrease in dollar velocity. These actions do not cause collapse. They create drag. The effect compounds over time. As more trade bypasses dollar settlement, reserve demand adjusts. As reserve demand adjusts, issuance becomes more costly. As issuance becomes more costly, policy options narrow. Monetary authorities can delay recognition by expanding liquidity. This works in the short term. Over time, expansion dilutes purchasing power. Dilution encourages diversification. Diversification reinforces dilution. The cycle tightens. This does not imply imminent failure. It implies structural stress. Stress that manifests first in volatility, then in policy distortion, and finally in repricing. Time also changes the behavior of capital. In stable systems, capital seeks yield. In stressed systems, it seeks preservation. When uncertainty increases, duration shortens. Long-term claims become less attractive. Liquidity becomes valuable. This shift alters market dynamics fundamentally. Asset correlations increase during stress. Traditional diversification weakens. Risk migrates toward leverage and long-duration assets. The most important consequence is not price movement, but optionality. Those who retain liquidity maintain the ability to act. Those who are fully allocated lose flexibility. Time favors optionality. History shows that currency dominance fades gradually, then abruptly during moments of systemic stress. The British pound did not collapse when the empire declined. It slowly lost influence as production shifted and debt accumulated. The process took decades. The inflection points occurred during crises. We are now approaching similar inflection points. Not because the dollar is weak, but because the system supporting it is stretched across time. Money cannot outrun physics indefinitely. It cannot ignore material constraints forever. When claims exceed capacity, adjustment follows. Time is not neutral in monetary systems. It is the force that enforces reality. Money under pressure does not vanish. It changes behavior, it changes incentives, and eventually it changes who holds power. Every global order eventually confronts the same force. Not ideology, not competition. Time. Time exposes imbalances that narratives can delay but never erase. It reveals which systems were built for endurance and which were built for speed. When time asserts itself, power migrates toward those who anticipated constraint rather than those who optimized for abundance. The defining feature of the coming order is not collapse, but transition. Financial systems do not vanish when they are stretched. They adapt, they fragment, they reprioritize. What changes is not the existence of money, but the hierarchy of what money can command. For decades, The dominant assumption was that financial claims could expand indefinitely because access to resources would remain open, cheap, and uncontested. That assumption no longer holds. Resource constraints are no longer theoretical. They are operational. They manifest through delays, premiums, bottlenecks, and dependencies that cannot be resolved with liquidity alone. This is the moment when physical reality reasserts itself. China's long-term strategy reflects an understanding of this moment. By prioritizing control over inputs, it has positioned itself to endure volatility rather than eliminate it. Control over resources does not prevent shocks, but it determines who absorbs them and who is forced to react. That distinction defines power in constrained systems. Western economies face a different challenge. Their strength lies in innovation, finance, and institutional depth. Their vulnerability lies in time. Rebuilding resource security, processing capacity, and supply chain resilience takes years, often decades. Policies announced today will not materially change outcomes tomorrow. During that lag, dependency persists. Time creates asymmetry. In such environments, money behaves differently. Long-duration promises lose appeal. Liquidity gains value. Optionality becomes a strategic asset. Capital shifts from maximizing return to preserving flexibility. This transition is subtle at first, then accelerates during stress. Currency systems adapt accordingly. Dominance becomes shared rather than absolute. Trade fragments regionally. Reserves diversify. Financial flows become less predictable. Volatility increases not because of instability, but because the system is repricing duration. This is not a failure of markets. It is markets functioning under new constraints. History offers clarity here. Periods of transition always favor those who understand structure over those who trust continuity. The Roman economy did not collapse when silver content declined. It adjusted unevenly over generations. The British pound did not lose relevance overnight. It faded as production shifted and debt accumulated. Monetary power follows material power with a delay measured in years, not headlines. The same process is underway now. For individuals and institutions, the implication is not panic, but recalibration. Strategies built for a world of surplus and stability must adapt to a world of constraint and competition. Diversification must extend beyond assets into time horizons, jurisdictions, and systems. Resilience must complement efficiency. This does not mean abandoning markets. It means understanding what markets are now pricing. Scarcity, reliability, control, duration. Time punishes leverage in constrained systems. It rewards patience, liquidity, and positioning. Those who are forced to act under pressure lose bargaining power. Those who can wait gain it. This is the quiet lesson of history. Power does not belong to those who move fastest. It belongs to those who move earliest and wait longest. The coming decade will test this principle. Monetary policy will remain active but constrained. Fiscal policy will expand but unevenly. Resource competition will intensify. Financial volatility will persist. None of this requires catastrophe to be transformative. Transformation happens through accumulation. Accumulation of constraints, accumulation of dependencies, accumulation of time. The next order will not be announced. It will be lived through altered incentives, through changed flows, through new assumptions about what is scarce and what is abundant. Power, money, and time are inseparable. Ignore time, and power shifts against you. Ignore power, and money loses meaning. Ignore money, and time becomes unforgiving. Those who understand this do not seek certainty. They seek alignment. Alignment with structure, alignment with duration, alignment with reality. Time always wins. The only question is who prepared for it.